The problems China have now are deep-seated structural ones.
I think the consensus is already that for China, the property sales may not go back to yesterday.
China's entire economy is about to collapse. Recent signals have revealed that the Chinese economy may already be in a recession. China faces unprecedented job losses, vanishing trillions, and deflation. Each case wreaks havoc on their economy, yet the most devastating blow has just been revealed. The Chinese Communist Party has attempted to silence the disaster, but the truth has already come out. The Chinese financial infrastructure is about to fall apart. So today, we're going to try to unravel the complexities of China's economic collapse. We'll explore the causes behind the ongoing deflation, assess its multifaceted consequences, and examine the strategies employed by the Chinese government to counteract this economic anomaly. Beyond China's borders, the implications resonate on a global scale, influencing international markets and trade dynamics. At the heart of this exploration lies the significance of understanding China's deflation not merely as an economic phenomenon, but as a pivotal force that may reshape China's role in the global economic arena. So, stick around to Profit Protection as we delve into this intricate subject and dissect its implications, both within China and throughout the interconnected web of the world economy. One of the most evident causes of deflation in China is the decline in consumer prices. Consumer Price Index figures reveal a sustained drop in prices, with a 0.3 decrease in July of 2023. This decline in prices affects various sectors of the economy, including housing and everyday goods. It can lead to a decrease in the purchasing power of consumers and, consequently, alter their spending patterns. Falling consumer prices creates an environment where consumers expect lower prices in the future, discouraging immediate spending and investments. Weak demand has played a substantial role in driving deflation in China, particularly in the aftermath of COVID-19. The pandemic disrupted supply chains, caused uncertainty in the labor market, and led to subdued consumer sentiment. As a result, businesses struggled to stimulate demand for their products and services. Lower demand reduces the pricing power of companies, leading them to cut prices to attract customers. In this scenario, companies often find themselves in a price war to maintain market share, contributing to deflationary pressures. Several policy decisions and economic conditions have also contributed to China's deflation, such as deleveraging effects. China initiated deleveraging campaigns to address its ballooning debt levels, particularly among local governments and corporations. While deleveraging is essential for long-term economic stability, it can suppress economic growth in the short term and contribute to deflationary pressures. China also implemented strict regulatory measures in its fintech sector and the housing market to curb speculation and mitigate risks. These regulations, although necessary for financial stability, can lead to reduced investment and demand in these sectors, further exacerbating deflationary trends. And the central bank's monetary policy decisions, including interest rate adjustments and liquidity management, can impact inflationary or deflationary pressures. In China's case, monetary policy has played a role in influencing the overall price level. The consequences of deflation in China encompass a wide array of economic and social implications, each with its own set of challenges and considerations. Now we're going to examine the multifaceted repercussions of deflation, shedding light on its impact on various facets of the Chinese economy and its potential global ramifications. Deflation poses a unique challenge to debt management in China. As prices fall, the real value of debt increases, making it more burdensome for borrowers. This situation can lead to debt distress for individuals, businesses, and even local governments. China's efforts to address its burgeoning debt levels become even more arduous in a deflationary environment. The increased real debt burden can hamper economic recovery and hinder investment, potentially creating a feedback loop of declining economic activity. Deflation can exert a substantial drag on economic growth. Falling prices often lead to reduced consumer spending as individuals anticipate lower prices in the future. Businesses, in turn, may delay investment and expansion plans, expecting weaker demand. This slowdown in economic activity can impede China's progress in transitioning transitioning from an export-driven to a consumption-led growth model. In the long term, sustained deflationary pressures may hinder China's ability to achieve its growth targets and aspirations. Deflation can exacerbate unemployment challenges as businesses grapple with declining demand and reduced pricing power. Cost-cutting measures often come into play. These measures can include layoffs and reduced hiring, leading to increased unemployment rates. In China, where youth unemployment has reached record highs, deflation adds another layer of complexity to the labor market, making it challenging for university graduates and young job seekers to find stable employment opportunities. China's deflationary trend carries potential global implications as well, particularly in the realm of international trade and markets. As China is a major exporter of goods to the world, its falling prices could lead to a flood of cheaper Chinese products in global markets. While this may benefit consumers in other countries, it could harm manufacturers in those nations, potentially leading to reduced investments and employment. Additionally, deflation in China may affect demand for global commodities and resources, impacting economies reliant on exporting these goods to China. As China represents the world's largest marketplace, shifts in demand for energy, raw materials, and food can reverberate through global supply chains and affect global exports. In response to the deflationary challenges, China's government has undertaken a series of measures aimed at mitigating deflationary pressures and supporting economic stability. The People's Bank of China, China's central bank, has played a pivotal role in addressing deflation through monetary policy adjustments. Key measures include interest rate cuts. The PBOC has reduced benchmark interest rates to lower borrowing costs for businesses and individuals. Lower interest rates can incentivize borrowing and investment, potentially stimulating economic activity. The central bank has also injected liquidity into the financial system through mechanisms such as open market operations and reserve requirement ratio cuts, or RRR cuts. These measures aim to ensure adequate liquidity in the banking sector, supporting lending and economic growth. Also, tax relief measures, including reductions in value-added tax, or VAT, and corporate income tax, have been implemented to reduce the financial burden on businesses and encourage economic growth. Now, assessing the effectiveness of these measures in combating deflation is a nuanced task. While interest rate cuts and liquidity injections can provide short-term relief by lowering borrowing costs and boosting liquidity, their impact on stimulating demand and reversing deflation may be limited without complementary fiscal measures. Fiscal stimulus, including increased government spending and tax cuts, can provide a more direct injection of demand into the economy. However, the effectiveness of fiscal measures depends on their magnitude and the efficiency of resource allocation. The challenge lies in ensuring that stimulus funds are directed toward productive investments that spur economic growth. Regulatory measures targeting specific sectors such as the property market and fintech industry aim to address underlying structural issues that contribute to deflation. These measures can help reduce risks and prevent the formation of asset bubbles, contributing to economic stability. Moreover, the housing market remains a focal point of concern. Stringent regulations aimed at stabilizing the housing market have brought about a level of uncertainty. While these measures seek to prevent property bubbles and excessive speculation, they must strike a delicate balance. Overly restrictive regulations could hamper housing sales and construction, affecting related industries and potentially contributing to deflation if not managed prudently. Restoring confidence in the private sector is another pressing challenge. Private businesses are essential engines of economic growth in China. However, recent regulatory crackdowns and increased scrutiny have cast a shadow of uncertainty over the private sector. Reinvigorating private sector confidence and encouraging investment and innovation are paramount to reversing deflationary pressures. The future trajectory of China's economy concerning deflation is contingent on several factors. The effectiveness and adaptability of government policies will be instrumental. Striking the right balance between deleveraging, regulatory oversight, and stimulus measures will determine the success of efforts to combat deflation. Also, reviving domestic demand, particularly consumption, is critical. Encouraging consumers to spend and invest is vital to counteract deflationary expectations. The success of this hinges on improved employment prospects, private sector confidence, and targeted fiscal measures. And it goes without saying that China's economic prospects are intertwined with the global economic landscape. Shifts in global demand, trade dynamics, and commodity prices can influence China's inflationary or deflationary tendencies. Implementing structural reforms to address underlying issues such as the skills gap in the labor market and inefficiencies in resource allocation will be essential. These reforms can help create a more resilient and sustainable economic model. China's deflationary trend has also far-reaching implications on the global economy, like we've already mentioned, influencing various aspects of international trade, supply chains, and commodity prices. China is a linchpin in global supply chains, contributing components and final products to a wide array of industries. Deflation in China may disrupt these supply chains in several ways. Businesses may face reduced pricing power, affecting their profitability and ability to meet production costs. This in turn can disrupt the smooth flow of goods across borders, leading to delays and shortages. China is also a major importer of commodities such as energy, raw materials, and agricultural products. A deflationary China may dampen demand for these commodities, potentially causing a decline in global commodity prices. This can impact commodity exporting countries, affecting their revenues and economic stability. Other countries and international organizations are likely to monitor China's economic situation closely and respond in several ways. International organizations such as the International Monetary Fund and the World Trade Organization may encourage coordinated policy responses to address global economic imbalances resulting from China's deflation. These responses could involve discussions on exchange rates, trade practices, and fiscal policies. Countries may provide support for industries adversely affected by China's deflation, especially if they're vital for national security or economic stability. This could include subsidies, incentives, or investment in strategic industries. So, China's ongoing struggle with deflation has significant implications, both domestically and globally. Balancing economic stability, regulatory actions, and stimulus efforts is crucial. Challenges like youth unemployment, reviving private sector confidence, and sustaining domestic demand are pivotal. And internationally, the influx of cheaper Chinese goods, supply chain disruptions, and shifts in commodity prices require vigilance. The future trajectory of China's economy in tackling deflation will depend on navigating these challenges effectively and instilling market confidence at home and abroad. In the meantime, make sure to keep it tuned to Profit Protection to stay up to date on all things related to the economy, geopolitics, and technology. You might even want to check out this other video we made where we discuss Emmanuel Macron's visit to China this past year that didn't go so smoothly. But before you go watch that, make sure to like this video and subscribe to the channel so you never miss a single upload. As for now, that's all from us. Take care and we'll catch you in the next one.